Okay, hello everyone. Welcome to QuickBooks for Real Estate Investors. This is part 3 of our video series. You've been with me for parts 1 and 2. We've set up a company file and we've gone through some of the initial windows and prompts of QuickBooks. And now we're ready to start working with QuickBooks. We're ready to start making some entries and using it to track and monitor our business. This video will show you what I consider to be the first couple steps that are not only important for your real estate business, but are really important for business in general. So what we're going to do today is get started on creating a bank account and funding that bank account from the owner's accounts. So if you're a sole proprietor, if you're a single member LLC, you'll be depositing your own money into a new bank account. If you're a multi-member LLC, you'll also be doing the same, but you'll have one or more partners involved in the deal who will also be contributing some sort of contribution or some sort of consideration, cash, most likely. So okay, let's get started. This is, like I said, part 3, and we're going to add a bank account and fund that bank account so we can buy rental real estate. The first thing we're going to do is we're going to navigate to what's called our chart of accounts. And I bring that up using Control and then A on the keyboard, so Control A. You can also bring that up by going to the top menu bar and going to Lists and then Chart of Accounts. Anytime you're working in QuickBooks, there you'll notice that if there is a shortcut, it will be listed next to the option in the drop-down menu. So Control A, that's where I got that from, Chart of Accounts. I always like to maximize to see everything I can. If you remember from part 1, QuickBooks asked us what type of business we had, and then it used a template to design or import, I should say, the chart of accounts for us based on what type of business we have. So I have not touched this since part 1, meaning that your chart of accounts should look the same if you've been following along, or should look very similar to this. So you'll notice that on the left-hand side, these are all the names of our accounts. We can sort by name. These are basically the description of what the account is. And for those of you who aren't familiar with accounting, you have, besides bank accounts, you also have accounts on paper that track your transactions, track your money, where it flows, track expenses, track income, track equity, assets, and liabilities. And those 5 things I just mentioned are the basic types of accounts that you may have. So you see I went over here to type. I can sort those by type. Assets are things that you own. So assets can be cash, assets can be rental property, assets can be washers and dryers, it can be vehicles. These are things that you own. Liabilities are things that you owe, so things that you owe to other people. Most common in rental real estate is a mortgage. You could also have some short-term debt. You might have some hard money debt. Credit cards are things that you owe. Security deposits are things that you owe. These are liabilities. Equity. Equity is what portion of the business you have left after your assets and liabilities. So the amount that your assets are worth more than your liabilities. And generally this is what you as an owner have contributed into your business. It's the percentage, it's what you would take if you sold all of your assets today and paid off all of your liabilities today, assuming that you could get book value at least for your assets. So it's the difference between assets and liabilities. And equity can be negative. Oftentimes, well, you're not in a good position if you got negative equity, but sometimes it does happen where the business has lost money and the owner either continues to put in more time or has to continue to put in more money to keep it floating. Besides that, those are what's called the balance sheet accounts. So if you look at a balance sheet, you'll see the balance between your assets on one side and your liabilities and equity on the other side. The accounting equation is assets equal liability plus equity. So assets must balance out against liabilities and equity, which is why it's called a balance sheet. The other important financial statement is your profit and loss, also called an income statement, or sometimes just shortened to a P&L. And what's on a profit and loss or a income statement, you guessed it, is income accounts and expense accounts. So of those, there are all kinds of different ways to break down and categorize expenses. You can see that of my accounts, I've got the most expense accounts. I've got telephone, I've got professional fees, insurance, bank charges, and there's only one income account, which is right now rental income. So we've got also some weird things down here. We've got other income and we've got other expense, and they're not that important now. We can get into that more later, but generally other income means income that is not related to your principal activity of business. So this is called late fees income. We don't expect to make money on late fees. It's just incidental to our business operation. When people pay late, we charge them late fees. Interest expense is another type of other income. If you sold some salvage material from one of your properties, that would be another example of other income. Other expenses is very similar. It's expenses that aren't related to the primary activity of your business, and the only one that we've got right here is Ask My Accountant, which is an account for you if you're confused, if you don't know how to categorize any type of transaction, you just throw it in there. Okay, so that was kind of long, but that was I had to get you familiar with the chart of accounts before we start adding or subtracting any accounts here. And remember, the title or the purpose of this video is to create bank accounts. So those also go on the chart of accounts. And the way we do that is, remember, we're operating in chart of accounts. We come down here to our bottom left where we see some menus, and we're going to go to account and then new. And oh, look, we can see that this has got a shortcut key, so Control N will make a new account. And like I described earlier, we have income, we have expense, we have asset, we have equity, we have loan and credit card, which are liability accounts, but we also have another option, which is a bank account. QuickBooks uses the term bank to separate bank accounts from other assets, and within the program, in certain places, you can only use a bank account. So if it's designated a bank account, then no other account can be used in that transaction. So we want to say a bank account. We definitely don't want to put our bank account as a fixed asset. So let's continue. Alright, account name. This is generally I name this whatever the name of my bank is. So I might just say US Bank, and then I have a descriptor after it. So checking. It's not going to be a sub-account of anything. A description here is optional. If you'd like to put a description, that might help you. Bank account number, routing number is optional. If you did not set up a company password in part 1, I don't recommend putting this in here because anybody can get in and look at your bank account and routing number. So I would just suggest leaving that blank. I'll use an example just to show you. Tax line mapping. For most of you, if you're not an accountant or a CPA, you're going to not worry about this or just leave it as is. And if this is a bank account that is part of an existing business, you're going to want to enter an opening balance. Okay? But if you say you have just started, you're opening up a new bank account, and when you open it up, you're going to fund it with $100, and then you're going to come back later and fund it, you won't enter an opening balance. But if you are the owner who has 50 properties already and you're just starting to use QuickBooks, well, first of all, congratulations. I'm glad you've chosen to get organized. But second of all, you'll want to enter an opening balance, and this generally will be from the last bank statement you received before your QuickBooks start date. This is important because we chose that in part 1. We decided when we were going to start our business, and I had recommended that you start the business from the fiscal year. So I'm in August as I record this video, and I had said January was when we were going to start this business. You also had the option of choosing what date you wanted to start your business, and I gave the example of July 1st, 2013. So if you had chosen July 1st, then if that's when you started your business and you opened your bank account in July, your ending date would be your statement date. So that would be 7/31, right? That ending date. So if you started in July, opened in July, you're going to get a statement at the end of July, and that's when you want to start. If you followed my example and you started in January, well, then your statement ending date is going to be January 31st, 2013. Okay? And say at that time your balance was $11,568.26. I don't know. Then you would enter that statement ending balance and statement ending date, and QuickBooks will automatically make an entry for you so that your bank balance starts from the excuse me, that was terrible. So your bank balance starts right, basically. If you're an existing business owner, there's no way that you're going to want to go back to say you started your business in 2004. There's no way you're going to want to go back 9 years and enter all that bank data in. It's just not practical. So it's okay if you have a business that's been started before you've started using QuickBooks. You've just got to use this opening bank balance feature. Okay? And again, be careful of the QuickBooks start date. Okay, I think that's clear. I do not have an opening balance because this is this company that I'm starting is starting from scratch, basically. So I'm going to click cancel. I guess I'll show this to you for those of you who are following along and do need to enter an opening balance. So I clicked OK. It says my statement balance as of this date was this. Alternatively, if you followed my example and say you started if you were an existing business and you started QuickBooks as of January 31st, 2013, then you might consider using 12/31/2012 as your statement ending date, because that will then include all of January's transactions. I'm sorry, I should have told you that the first time. So my mistake. If you entered January 1st, 2013 as your starting date of your QuickBooks records, then I would use the December 31st, 2012 statement of your bank account. Okay? That way, you'll enter January's transactions in. The way I had just shown you was wrong, because I would have ignored January's transactions. So that's good there that you see me make a mistake, because that's probably a common mistake that people might make. So always want to go back to the previous the previous period, whether it's month or quarter, before you told QuickBooks your start date. Okay, that was a little confusing. Sorry about that, but if you started with me January 31st, 2013 or January 1st, 2013, your statement date should be the month before. And like the other example was starting on July 1st, your statement date would be June 30th. Same thing, it's always the period before. So I goofed that up, but hopefully that's clear to you now. Okay, so cancel, and I'm going to change. Oops, I'm going to change this back to nothing because in my company I'm starting completely from scratch. You know what, I'm going to change that because I don't think a lot of people out there are probably starting completely from scratch. So I'm just going to make this up. I'm going to say that I started with $5,000 and I ended my bank account last year, so 12/31/2013. That was my last statement date before I'm starting my QuickBooks record. If you remember, I'm starting my QuickBooks record January 1st, 2013. So I'm saying in my checking account, in my U.S. bank checking account, I ended 2012 with $5,000 in the bank. Okay. We've done that. Alright, save and close, that's all you need to do. You've got this account name, everything's good. Save and close. It's going to say, well, I've got my settings set that it's going to say, hey, this is more than 90 days in the past. Are you sure you want to do this? And you say, yes, I want to do this. Okay, now we're going to go back to our chart of accounts, and we can see that now we have a new account. It's called U.S. Bank Checking. The type is a bank account, and our balance is $5,000. So we have got money in the bank. Now, this account called Opening Balance Equity is used to basically record opening balances, what you started with. If you notice that we started our bank account with $5,000, and that means we also have $5,000 in equity, because that equation, assets equals liabilities plus equity, has to balance. So we have no liabilities, so it must be all equity. So we've got to put that $5,000 somewhere. We can't just put it in the bank account and not balance it out on in another account. The way accounting works is that it's called double entry accounting. All transactions must have two accounts. You cannot just put $5,000 into a bank account without putting it somewhere else in QuickBooks. So it's got to have another one of these accounts. We can't just say, hey, I'm going to put this in checking and that's it. It's got to be, I'm going to put this in checking and it's going to also go into equity, or I'm going to put it in, I'm going to take it out of checking and it's also going to go to an expense. So there always has to be two accounts in every transaction. And in our funding transaction, there were two accounts. Okay, I'm going to stop here because that's probably a lot. I need to get a drink of water, but that is good for now. I'll come back in part 4 with adding a savings account. And so that was a lot, actually. Chart of accounts, familiarization, and opening balance mistake by me, and then correction also. So, okay, we'll see you in the next part. Like or dislike, tell me how I'm doing, leave a comment. Thanks for watching.